Well, I appreciate the chance to speak with you. Again, I'm Dan O'Brien. I'm an Extension Ag economist with Kansas State University. And in what we're going to talk about today, I want to talk first about the general markets and some of the overall economic factors affecting, well, ag commodities, the grains in particular. First off, for about a 5-minute segment, 5 or 6. And then we'll go and we'll talk about corn, and shortly after that, grain sorghum. So that'll be segments 2 and 3. Segment 4 will be, I think it's wheat, and then we'll finish up with soybeans. So let's start right in. The closes on the markets yesterday on a report day were really kind of they were unexpected. The USDA numbers came in for ending stocks for all of our major commodities came in on the higher side. Again, there's some demand issues that we'll talk about as we go through this. But it turned out that there was some export news, some other developments around in terms of the crop producing areas, crop exporting areas around the world that led to the corn market, which had negative news in the supply-demand balance sheet, actually closing a little bit higher. Soybeans closing up about 9 cents, and wheat closing up 14. Part of what wheat's closing up higher were literally rumors, probably more than rumors, concerns about what cold weather could do to the hard red winter wheat crop coming on. I would say on this first page, we've got some things that have sure changed. When you look at that futures and cash price ratios on April 9th, and right below that set of futures and their closes, you can see that under current crop 2019-20 and next crop 2021, you can see that the soybean to corn price ratios are now 2.59, 2.6, thereabouts, 2.5, 2.6, and normally when you see a ratio of 2.3, 2.4, thereabouts, you're really favoring soybeans. So probably it's the line to pay attention to is that second line, new crop, November beans versus D's corn, and a 2.5 ratio of those prices, those new crop futures. The USDA, when they came out with their planting intentions report, had showed 97 million acres of corn, I think about 84, 85 of soybeans. We'll talk about that. And but boy, a lot has happened since those surveys were done the first 2 weeks in March. So if we do see the USDA, if the U.S. corn acres and soybean acres start to trade places, corn down, soybean up, probably have a lot to do with this type of a ratio and farmers' expectations in regard to that. You might note also the hard red winter wheat to corn ratios. We are just not going to feed a lot of hard red winter wheat given cash prices and futures for wheat being so much stronger than for corn. Note also that last line, sorghum to corn ratio. We have been bouncing along for a good long time of sorghum being about 88, 89, 90% of corn. Well, now this, with the newfound export strength for grain sorghum, the relative price of sorghum to corn has crept up. If you really see sorghum exports start to grow, again, we could get back to the days before the U.S.-China trade conflict when gee whiz, we saw corn and sorghum about par when it was driven by exports. Okay, there we go. And I just want to quickly show you a few things. We are in ag, we're affected by the stock market. You can see the drop-off that happened. This is weekly Dow Jones Industrial Average Complex. It's an index, excuse me. And you can see the drop and then some of the recovery. The recovery was associated with actions by the U.S. government. Dollar index, this is a big deal by the U.S. government stepping in and the Fed backing up the dollar, backing up the economy. The U.S. dollar has become a safe haven for currencies around the world. Again, if we hadn't ever seen before or didn't think of how the U.S. Fed affects the whole world economy, we're just seeing it right now. So the U.S. dollar is relatively high. This is a good indicator for confidence in the U.S. economy overall, but it's a rough thing for grain export markets, especially for wheat. And we'll talk about that more. Of course, a big issue in the world has been Saudi Arabia, Russia having basically a trade war over in OPEC, with I think the unofficial unnamed target being U.S. shale production, or now North American shale production. So you've seen oil prices fall off. You'll note that we were down to 25 or so there for a while, and following that, gasoline prices fell from, well, for unleaded gasoline CME futures contract, you see that $1.80 a gallon. It fell off to a low of about 46. So that is no small potatoes when you start talking about drops and changes in market. Now it's started to come back a little bit. Of course, the issue that we're hit with is that this comes straight back at and hits the ethanol market, and of course we're seeing plant closures now, all part of that. And I would say the last thing, Alicia, last slide for this part. Ag commodities have not been the only ones that have taken hits. You can see this aggregate index, with energies, grains together. Generally, you saw most commodities as a group all fall off together, and closures of the parts of the U.S. economy and skittishness, worry, etc., all in play. I'm not a chartist, but I would say that there's RSI index up there. When you see that it goes between 30 and 70, it's kind of a measure of market momentum. We're still in the dumps with regard to market momentum for all commodities. So this is something you don't normally watch, but when that starts to turn more positive, then you got, in a broader sense, you're probably seeing the U.S. economy doing a little bit better. So Alicia, with that, that would be the end of this first segment. We'll go into corn next.
Sounds good.
And what your people could do.
You are recording.
Okay, now recording. Heading off into the actual grains. All that moisture we were worried about last year, well, there's still a lot of subsoil in different places, but you look at the last 30 days of accumulated precipitation relative to normal, about the only dry place in the Corn Belt, there's a little streak through Illinois, and oh yeah, a good chunk of Kansas has got that too, up in the southeast Nebraska. So nobody's complaining really in terms of planting season, but we've had such challenging and volatile times weather-wise that it just bears watching to see when you look on the right, see 7-day accumulated precipitation as a percent of normal. You know what? It's we haven't been getting rain yet. Mary Knapp just came in and stated this morning on radio, through KSU Ag Today, was talking about various trends going on off into the summer for weather. So interesting it'll be good to watch this. Let's talk about corn. Key points for corn markets: ethanol corn use is at risk. The damaged U.S. economy is that the lower fuel demand, and the oil price war has lowered the ethanol price. So 1-2 punch. Loss of 200 to 500 million bushels of U.S. corn use for ethanol plants. Made that statement before yesterday's report. The USDA dropped corn usage by 375 million bushels on their estimate for ethanol. That was for corn. For grain sorghum, dropped at about 25 million bushels. So they came in basically at about 400 million bushels. Now, they also raised feed use. And what's happening is, if the ethanol plants aren't, if they're dropping 400 million bushels of corn usage because of closures and whatever, scale back, slowdowns, they're not pumping out DDGs. So you're having to figure out, well, those DDGs not being on the market, are we going to have corn feeding come back in and take the place of the DDGs that aren't there? And by the way, if you look at the DDG market, for dairy and some of the livestock species that are really is important for, DDGs have exploded in terms of prices. Now, after jumping way high, we'll show you that. 2020 corn planting prospects came out end of March and said 97 million acres was the survey number, based on contacting with producers first 2 weeks in March. And then all the rest of this has come into play. Pre-report, post-report, market expectations are 93 to 95. But there's a warning to have here when we look at what the USDA will do. We spent all last year thinking, gosh, USDA has to adjust down acres. They have to make such changes. Gosh, it seems to be what we see. Well, they didn't, and they kept putting off the issue. So so we'd have made money if you were a trader last year just knowing what the USDA was thinking. It may still end up, because you're here in the May report, they're going to actually give that number out. They're going to actually do the survey to the north. So what's my point? The point is that the USDA has shown a marked procrastination in dealing with some of these issues until they have everything exactly in hand. And that's been one of the greater sources of frustration that farmers have had this year, is that the market trades on those numbers, and the USDA has been loath to make changes to adjust them. So I'm not trying to get pitchforks going to Washington, but that's just the reality. Estimated 2020 production in stocks, if we really had 97 million acres or thereabouts, we'd be looking at a big corn crop, 15 billion bushel plus. Ending stocks from 2 to 2.5 billion bushels, 18-20% stocks to use. And if you just look at what our price relationships are, the USDA came in and put in and forecast about 360. If you really have 18-20% stocks to use, you're probably 330, 335, 340, something like that. So I know why they did it, but because they're hesitant to upset markets, et cetera. But if we really get those bigger crops, we're probably looking at a lower corn price this fall. Now, to stay in time, I'm going to really move quickly through some charts here on corn, just to show you some highlights. And Alicia has a copy of this and can send it to you. Here's that supply-demand balance sheet that came out yesterday for corn. Again, you can see the changes. They upped feed residual. Look, you have over here on the left-hand side of what you're looking at, you have the columns named. Then 2018-19 marketing year, 19-20, that's the one we're in until end of August. And then you see the changes from the March report to April. So they upped feed residual usage. Again, some of that's DDG coverage, lack thereof. They did drop ethanol, 375 million bushels. Exports left unchanged. Interesting. So ending stocks out of all that up 200 million bushels. Stocks to use ratio about over 15% now, and they dropped the price. It was 380 they're projecting. Now it's 360. And you just heard me say, if you look at historic relationships, the 15% stocks to use, who would be surprised, given the pressures we're facing, that we end up close, 10, 15, 20% lower than that. CME futures, you can see the drop off we've had. Closed yesterday 331 3/4, and it is what it is. Corn, with the hit at ethanol demand in particular, has really had a pretty pessimistic view of things. We do have some decent basis. Now, it is telling. I grabbed the most consistent basis that I'd had. I looked at local sources, and they weren't bad, but they weren't as consistent. So I went to Hutchinson, where I had good daily data that I could draw these charts from. So there you go. So Hutchinson, a Cargill location, had been having, until all this hit, pretty strong ethanol, pretty strong basis, and now starting to dive off. It is interesting that in the drop off over the last several weeks, that it started to go sideways at 20 under. So something to watch. And you can see, just to show you what the prices are central and eastern Kansas as opposed to western Kansas for corn. Top bids in either Atchison, Topeka, and they're kind of export oriented. All that much more. Topeka gets a little bit of that ethanol plant down at Garnett. Out to the west, you do get Sublet, Ulysses. Basically, those are feedlot led bids. And wanted to show you the ethanol prices. Note, we still have in Kansas a 5 cent over basis bid at the top end of our for corn. So that's a positive. That grain sorghum basis bid on the lower right side, 10 under. That's probably one of the best basis bids for grain sorghum in the United States. And we're putting them into some of our plants. On the right-hand side, look at how ethanol prices have fallen off, they're all together. And but on the lower part on the right side, see how distillers' grains have jumped. So distillers' grains have jumped, ethanol's fallen off. In the overall picture, figured in some other presentations, other analysis, ethanol plants were losing about 25 cents a gallon on average in January, February. March dropped down to about 43 or so cents, and they were continuing to operate at 25 loss. When there are some that when they went to 40, 50 cent loss, that triggered them. That's beyond their marginal cost, lower than that. So you're seeing closures now. And for corn and grain sorghum exports, and Alicia, this will be the last one on this, and then I'll talk about the corn, and then we'll stop, and then we'll give you a break to switch the tape around, and then we'll talk sorghum. But to talk about corn, so this drop off in corn led to the biggest, for the week ending April 2nd, the largest week of corn exports the United States has had all marketing year for a fair while, 51 million bushels. So low prices shook the natives out, and got things coming. But what's the future of this? So look at that blue line there, total sales through April 2nd, 1.33 billion bushels. That's 77% of the USDA's projection, 1.725, and we're about 60% of the way through the marketing year. So that's been getting better. So maybe that 50 million bushel is probably the first week for weeks and weeks and weeks that we ever got above the pace. See that line in the red needed that we needed to meet the USDA's projection. It was, we need at least 45 million bushel a week. We finally got a week over that. So the tail to watch will be how strong we have these weekly sales or not.